Well, Andrew Milligan helps oversee $260 billion as head of global strategy at Standard Life Investments, and he joins me here now in the studio. Andrew, thank you so much for coming in. I guess the first question that we need to ask ourselves is, how much do your clients want to take risk? Because there's so much volatility that if you have a wrong stomach, a strong stomach, then you do, you can find cheap valuations, but if you don't, you should just stay put.
I think that excellent question, and the word risk is absolutely paramount. I mean, I think the good news for many investors who aren't able to take risk is that the next few days, weeks and months do look a good buying opportunity. We don't see recession yet. Therefore, we see this as more similar to the April, May, June of last year, when we had these double dip worries caused by various different factors then, before eventually a market recovery. So we think there's some good buying opportunity, and you can see many equities and markets have been oversold. The bad news is, and I hate to say it, this is going to be a very slow growth recovery for several years to come. So investors should not expect good returns.
And you also said we don't expect a recession yet. What does that mean? Are you expecting a recession in 2012? Are we going to be at the brink of a recession in 2012?
The good news, I think, is that many of the facets that were causing people to worry about the world economy, the tightening in policy in China, the rise in oil prices around the world, those actually look to be going into reverse. We're already seeing mortgage refinances picking up in the United States, for example, gasoline prices lower, Japan recovering. So I think actually in the third and fourth quarters we'll start to see some good economic news coming out. We saw some last week with the jobless claims, the retail sales in America, for example. But 2012, that's the year when fiscal austerity bites for a lot of countries. Policy errors, you can imagine lots of issues coming along. This is going to be a very slow growth environment. My simple analogy is it's a bicycle moving very slowly, and if you're moving very slowly, you can tip off quite easily.
We're just going through the indices, and it's actually a very telling day, because we started off a little bit lower because of the descent we see within the Fed, and now we've seen a sharp fall in the DAX without really any explanation. It's either positions that have increased too far too quickly, or just a little bit of fear out there. How much do you expect this fear to continue and the volatility to continue?
I think the volatility will continue and pick up. The VIX index of volatility has fallen back towards 30 or so. Last time around we got much higher, and I think we will. I wouldn't be surprised at all if the FTSE doesn't test again 4,800 on the index. But this, I would absolutely emphasise, is entirely normal during these sorts of circumstances. Again, I repeat, in May, June, July last year, we saw a 2-3 month period when the markets oscillated sharply up and down before finally a floor was formed. And from a chart point of view, you often do need to test the floor several times. So I think we are going to see lower before eventually higher.
Andrew, what I'm, I guess, concerned about is that we talk about circumstances, but they're very different from what we've seen in the past. As is everything, nothing's going really wrong, but nothing's going really well either. And if you look everywhere in the world, the US is not doing great. We talk about QE3, but will it work? Will it not? Here in Europe, well, we're still in a mess because of periphery. And also China's not looking great. So is there going to be one catalyst which is actually going to give investors a little bit of an oomph, when they feel that they don't have to be as risky as, or risk averse as now?
No.
Okay.
Next question. No, absolutely, there is not. And too many people are looking for silver bullets, a solution. With all respect to President Obama, his jobs package is not going to kickstart the US economy. It'll give a 6 or 9 month rally in the US economy in the run-up to the election. Golly gosh, what a surprise. We are facing a situation where for several years we're going to be seeing this slow, drawn-out deleveraging, constant risk of recession on the one side, worries about what the politicians are going to do to try to create growth on the other. Deleveraging lasts and is painful. Yeah,
and we don't really know who's in charge, actually. Is it the central banks? Is it the politicians? So what does it mean for equities? Are we going to be in this kind of wait-and-see situation for the next 6 months, or even longer?
There I would say it is easier, because it is the politicians, ultimately, who are in charge. Central banks are no longer independent in any country around the world. They really have to do what the politicians say. The difficulty is, as the Merkel-Sarkozy summit on Tuesday showed, is they're not entirely sure what they want to do. Even if they are, they've still got to bring the electorate along behind them. So politics have always been important in markets. They're now terribly important in markets. We have to be central watchers, economy watchers, and politician parliament watchers at two. 3 eyes, 3 hands, that's what we need.
So let's go back to, if you're an investor and let's say you have an appetite for risk, valuations looks pretty cheap, what would you be advising them to do at the moment? Buy when stocks are down like Warren Buffett? Do they have to wait a couple of weeks until valuations are still at these levels but stocks go down a touch, or still remain very prudent?
Well, as you said earlier, let's define a high-risk investor and a low-risk investor. The high-risk investor has to say to himself, I don't think recession is going to happen. Ergo, I'm going to be buying some cyclical stories that are out there. And for that, I think we would be buying a mix of some of the most oversold markets and companies. Generally, recently, most markets have fallen about 20%, give or take. And yet the economic outlook for many of these is completely different. So choose the ones that you think are actually going to do well. And similarly on a corporate basis, some of the luxury good producers, some of the industrials and cyclicals, for example, you'd probably be buying high yield bonds at the moment. Yes, of course, they're under pressure because people are worried about recession. The yields have moved out sharply, but there'd be opportunities there. You'd probably also be thinking about buying commercial property. I mean, commercial property does not do well in recession for a very good reason. If there is no recession, a high-risk investor will be saying to himself, can I buy some of those real estate investment trusts, some of those other opportunities that are out there? So I think you'd probably be buying cyclical stocks, high-yield bonds, commercial property. That's the sort of high-risk strategy that someone would be saying.
And in terms of the industry groups, for example, again, this is for the high-risk investor, some of the industry groups you mentioned, luxury, across the board, or is it the companies that are more skewed to emerging markets where growth still seems to be higher than anything we've seen here?
No, I think it would be across the board because really the high net worth individual, those few, that are out there are actually doing quite well. And we've seen that in the reports of a number of US retailers recently that have done quite well. The differentiation between the Walmarts and the upper end is really quite noticeable. So I think it would be high-end retailing, but the high-end producers, certainly.
And Andrew, talk to me about the low-risk investor.
Yes.
What should they be doing in this environment?
Well, the low-risk investor is obviously saying to themselves, I can start to see some value, but I hate to say it, but even today there is not great value that's out there, because I would be looking for probably PE ratios or price-to-book ratios that are even lower than this. So I might be starting to buy equities on the down days, but I'd be only slowly putting my foot into the water. The sorts of stocks, obviously I'd be looking for equity income type stocks. I'm looking for companies that I feel will survive whatever the world throws at me for the next 5 years. So I'm looking for companies with very solid brands. Probably some of them will be exposed to the emerging markets again, perhaps some of the German auto companies, for example, that will survive and come through, or a number of the perhaps utilities if they're not going to be regulated out of existence, as the Italian episode showed a few days ago. You're probably buying more investment-grade corporate bonds. Yep. You might even still be holding the long end of government bond markets. If we do see the flattening of curves continuing, all these stories about whether the West will become more like Japan, 3.5 on the US 30-year might actually seem a bargain in a few months' time. So you'd be buying the same sorts of assets, bonds, property, equity, but you'd be looking at a slightly different skew to make sure that actually you're picking up value as well as quality.
I guess central banks are the key. Andrew,
Certainly
you've said
today,
that actually
yes.
you don't think they are independent anymore.
Well, since quantitative easing has begun, and quantitative easing is eventually a decision by the Ministry of Finance in any country,
right.
Then central bankers are much more beholden nowadays to what governments want at the end of the day. I mean, I think the statements from the Fed is quite right. Of course, they are not required to protect the interests of equity investors, why should they? But they also will be very well aware that if equity markets fall too fast, too much wealth, too much of a knock to consumer confidence, that's when you get the horrible cycle building up into recession.
But these fractions that we're seeing, you know, the Fed, this is the first time in a very long time that I can remember the Federal Reserve open dissent and qualifying why they're dissenting. The Germans also dissenting in the European Central Bank. Do we run the risk that the markets become less convinced that central banks are a good thing for the markets with this very apparent squabbling?
Well, I think several points there. One, ultimately, if we do need to inflate our way out of these problems with further massive forms of quantitative easing, it's only
would you say in the first instance, yes, we need to inflate our way out?
No, I'm not saying that. I'm saying it's simply one option.
Okay.
So the central banks may well eventually be the 7th Cavalry riding over the hill. But before then, markets prefer one voice to be speaking. That's partly why the Eurozone problem has been it's 17 different countries, a whole series of different... I don't think it's a surprise, though, that central bankers, and these are very intelligent, very honest men, just as the three of us will disagree on an issue, they are disagreeing. There is considerable uncertainty about the way forwards for the global economy and the correct policies to introduce at this moment in time.
But they could keep it behind closed doors, because the problem is that the markets have been getting so many mixed messages, and all of these debates, actually, if you look at a round of people, just make it more difficult for them to understand. Markets get it wrong.
Markets do get it wrong, and that's because some investors are just too short-term and don't understand and analyse enough. No, I disagree with that. I think central bankers do need to be transparent. I go back to the old Mervyn King statement of central bank policy making should be boring, in the sense of it should be so transparent we can do their job for them. and I still think that that is the case. I wouldn't like it if a central bank was extremely quiet and then suddenly did a complete 90-degree change of 180-degree change of view, getting my degrees wrong there, 180-degree change, and off we went.